Good afternoon. Let me show you how the Fearless Market Momentum portfolio addresses risk and return like no other. Sit back and I'll tell you the story of how to get from here to here. And while things under the hood may look complicated in places, keep in mind at the end there is an easy button. The story starts with my first momentum strategy in the late 80s. It was pretty simple. I bought Money Magazine's annual ranking of mutual funds, identified Merrill Lynch's best 2 funds, and bought them. How did that work out? Over 7 years, the market was up 100%, but my IRA funds lost 5%. My money would have been better had I stuffed it under a mattress. I then hoped to find a common thread in newsletters, but didn't. I even watched CNBC and found they could serve up 8 simultaneous different opinions. I eventually found that my coffee mug was right all along. If the nation's economists were laid end to end, they would point in all directions. Still on the hunt, in 1992 I developed this Quattro spreadsheet experiment to determine if trends exist in market data. And that answer was a resounding yes. I found confirmation for that in Edgar Peters' 1992 book, Chaos and Order in the Capital Markets, and in Jagadish and Tietman's 1993 seminal academic paper on momentum in market data. Finally, even Nobel laureate Eugene Fama and Kenneth French confirmed in their 2008 paper that momentum was the premier market anomaly that's above suspicion. Momentum is real. By definition, it's a portal to the future where something in the recent past tells us something about the near future. In fact, momentum is the crystal ball we all hope to find, even though market noise makes it foggy. Seeing even a little bit of the road ahead changes everything. As a Stanford-trained signal processing engineer, I knew that reducing the noise was job one, and this man is where to start. Claude Shannon, Nobel Prize 1939, showed that the signal-to-noise ratio controls the probability of making the right decision. There are 2 important tools for improving signal-to-noise ratio: matched filter theory and differential signal processing. Jean Van Vleck, Nobel Prize 1977, gave us matched filter theory, which specifies how to design a momentum filter for optimum signal-to-noise ratio. This boxy-looking 12-month simple moving average momentum filter is pretty much the state-of-the-art in academic papers and many live strategies, but it's no more optimized for performance than this boxy-looking Model T. A little bit of work shows the optimum design can be really quite different. In fact, the optimum design depends on the character of the funds in the strategy, which should not be surprising. More about this can be found in my 2016 Wagner Award paper entitled Automated Polymorphic Momentum. Samuel Christie, Royal Society 1836, gave us differential signal processing as a way to eliminate common mode noise and improve signal-to-noise ratio. Its implications are profound. It means that comparing the relative strength of many funds together actually produces superior results as compared to standard single fund analysis. Here, the momentum signal of 6 funds are compared in the lower chart, and the momentum leader is the fund owned in the upper chart. Let's put these principles to work with our favorite spider sector ETFs and see what happens. It produces these results over 18 years with the S&P 500 in strategy performance as shown. While definitely an improvement, these rough spots show why pure sector rotation still engenders fear. What more can we do with ugly stuff like this? Well, we could detect the onset of bad markets, perhaps invest differently in bad markets, and maybe diversify further with a portfolio of strategies. Let's examine these possibilities, then start building our fearless portfolio. Detecting the onset of bad markets is the job of a market direction indicator. Simplistic indicators, such as the well-known death cross, perform only marginally well. Simply sensing market direction is often too little, too late. It turns out that sensing market safety is a far better thing. Our StormGuard Armor indicator is a composite of 3 separate views of the market that are combined to determine market safety. When applied to the S&P 500 in gray, the profound improvement in green is achieved. Once StormGuard Armor has determined stocks are unsafe, a designated bear market strategy takes over, using a set of funds likely to do well in a down market. This bear market strategy selects from a set of 3 different bond ETFs and 2 different treasury ETFs, and does provide significant additional returns. The purpose of a portfolio of strategies is simply to further diversify by owning divergent ETFs. 4 strategies with divergent asset classes are created: sectors, global regions, commodities, and Trump plays, each strategy selecting its momentum leader. Finally, we must have risk and return performance benchmarks for comparison. This consensus set of risk category definitions is based on the model portfolios of numerous respected industry leaders. The portfolios use 4 asset classes: U.S. stocks, foreign stocks, bonds, and a money market, with allocations typical of the 5 classic portfolios: aggressive, growth, moderate, conservative, and income. These portfolios are benchmarks against which others can be numerically judged or defended. Now let's actually build the portfolio. We'll start with the spider sector rotation strategy we saw earlier, then incorporate Storm Guard armor, where the white segments are taking us to cash, and finally adding the bear market strategy. Let's do that one more time. Going to cash, sector rotation only, Storm Guard armor to cash, and adding bear market strategy. Is that profound or what? This is how the fully complete global strategy turns out. The fully complete commodity strategy looks like this, and the fully complete Trump plays strategy looks like this. Finally, they're rolled together as a portfolio of strategies with that sweet equity curve. Not only does it have return to beat the band, but less risk than a classic conservative portfolio. That's why it's called fearless market momentum. These strategies have strong technical allies, and they're easily managed. Better yet, it's plug and play with Riskalyze Autopilot. Select from a list, attach to an account, and Autopilot takes it from there. How easy is that? Now that's worth writing home to mom about.